America's national debt is soaring, and federal interest payments on that debt has surpassed a staggering $1 trillion annually, straining the budget and spooking investors. That figure is now larger than the defense budget and more than the combined costs of Medicaid, disability insurance, and food stamps. This development marks a turning point in the nation's fiscal stability and raises major concerns for investors, policymakers, and everyday Americans like you and I. Every time the federal government runs a budget deficit, it fills that gap by auctioning bonds on the open market. And to entice investors to buy these bonds, the government must offer higher interest on those bonds. So when doubts grow about the government's ability to repay that debt, interest rates must go up higher and higher. And as that debt accumulates and interest payments on that debt grow, the cost to the U.S. government of servicing that debt also grows, as does the risk that the government won't be able to repay their balances. Now, this sets off a dangerous chain reaction where interest payments compound into future debt. That debt becomes riskier, and interest payments must increase further to then entice investors to take on that added risk. This creates a scenario that some economists now warn may lead the U.S. into a full-blown economic crisis. Famed investor Ray Dalio didn't mince his words when he said that the U.S. has 3 years, give or take a year, to avert an economic heart attack. He believes America is approaching a debt death spiral where, again, that debt becomes so high that the only way to sustain it is by taking on even more debt at even higher interest rates. Dalio noted that these warning signs are often ignored by lawmakers until the crisis is unavoidable. The change is unthinkable, and then it happens suddenly. Ben Harris of the Brookings Institution puts it plainly: if the perceived risk of default on U.S. Treasury bonds goes from 0% to even 0.2%, that's a massive shift because we're talking about trillions of dollars. Treasuries have long been considered the safest investment in the world, but if markets begin to treat them as risky, the entire financial system could be thrown into turmoil. This erosion of confidence is already underway. Investors are increasingly turning away from U.S. bonds and looking instead to European and Asian markets for more secure options. In fact, in May, the interest rate on a 30-year U.S. government bond spiked to its highest level since 2023, and this is evidence that the markets are beginning to demand greater compensation for taking on U.S. debt. To add to the distress, the U.S. has already been downgraded by all 3 major credit rating agencies. In 2023, Fitch stripped the U.S. of its AAA rating. More recently, just this year, Moody's downgraded the U.S. from AAA to AA1, with the U.S. losing its last AAA rating. Now, these downgrades raise borrowing costs, and in turn, they amplify the chances of entering into that debt death spiral. Rising federal interest costs don't just affect Washington, they hit your wallet too. Higher interest rates make everything more expensive. That includes mortgages, credit cards, car loans, student debt, and of course, small business financing as well. These increased costs ripple throughout the economy, they stifle manufacturing, discourage investment, and ultimately, they slow down growth. The Committee for a Responsible Federal Budget estimates that if the yield on the 10-year Treasury note stays at current levels, it would add $1.8 trillion in interest payments. And if yields rise even a bit, the damage could be much worse. Now, JP Morgan CEO Jamie Dimon has warned that a surge in yields could crack the bond market entirely, and this prompted panic among regulators that were in the room. Economists don't agree on when a full-blown crisis might erupt, but they do agree that it's coming. Former IMF economist Kenneth Rogoff noted that most defaults don't wait for the math to force them. They happen when confidence collapses. He says almost every country default, either through outright default or high inflation, occurs long before debt calculus forces it to. Now, Treasury Secretary Scott Bessent has stated that the U.S. will never default, but he suggests that it could always inflate away its debt. But that solution comes with its own risks: rampant inflation, a falling dollar, and of course the loss of global trust in the U.S. financial leadership. With the debt crisis looming, it's more important than ever before to think about how to protect your wealth. As faith in the Treasuries wanes and borrowing costs, of course, rise, the financial landscape is growing increasingly uncertain. And if you're concerned about what you see with the dollar, the bond market, the growing government debt, I'm Mackay Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals into your portfolio can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.